All right, I'm so excited today to have Clinton Donnelly with me, Clinton from cryptotaxaudit.com. And we met at the XRP Las Vegas event. We were speaking on a panel together, and I was so impressed with his stories and what he was doing for crypto investors that I wanted to have him on the show today. So, welcome, Clinton.
I am really glad to be here with you and your listeners, Linda.
Thank you. Well, gosh, there's so much that we have to talk about in the crypto world. So much is happening. And you at the XRP Army conference had the most colorful stories. So I hope we can share some of those stories with the audience later. But first, I want to talk about just crypto and how is crypto taxed? Because that's very confusing to many people.
It really is, especially since so many people are the only investing they've ever done is in cryptocurrencies. They've never seen the tax experience, if you will, of stocks and bonds and uh, you know commercial real estate and that sort of thing. Cryptocurrencies are considered property under the tax law. With property, you experience income when you sell the property. The income is the gain over what you bought the price for. Now, a little terminology there for you. Of course, what you bought it for, we call that the cost basis. What you sold it for is the proceeds, and the difference is the gain. Hopefully, it's a gain, and it's that amount that you're taxed. And if it's a loss, then that could be like sometimes we have losses. And at the end of the year, you add up all the gains and losses, and then whatever that net amount, if it's a positive amount, that is treated as a taxable amount of your income. And if it's a net loss, then you can only write off 3,000 of it, but the rest of it's carried forward and it can be applied to future gains in the next years. One subtlety on capital gains is that if you hold an asset for less than a year, then that gain is taxed at your marginal tax bracket, the same bracket that your wages are taxed at. Okay. But and this is a big tax incentive. If you hold that asset for more than a year, when you sell it, you get a special break. Congress wants to reward that behavior. So you get long term capital gains rates, which are 15% for most people. And that's almost half of what your normal rates are. So, a lot of people say, what are the biggest ways I can reduce my taxes? And they're really the two biggest ways to reduce your taxes are hold out for long term capital gains. And secondly, is live in a state where there's no capital gains, which in your case, living in California is like, too bad.
Yeah. Oh, yeah. We're taxes too.
Right. Because California, I think the capital gains rate's 13%. So, and that's on top of let's say the long-term gain rate of 15% that the government's taking. So together you're at 28%. So you can see that's a big, that's a big difference. So if you're somebody who's looking at a big payout, you might want to make some strategic decisions. And one would be to focus on long-term gains and maybe if it's within your capacity to live in a state where there's no capital gains tax. So that's capital gains. The other type of income we make with crypto is sometimes it's staking rewards, um, and a variety of type of reward. There's so many of them, and these are generally treated as income at the fair market value in U.S. dollars when you receive them. It's that income is taxed at your marginal tax bracket, just like if it were wages, but there's no Social Security tax on that. So that's the two major aspects of income, and a lot of people forget about that in the excitement of investing. They forget that, I made a big gain. I just sold this. I sold 100,000, and now I'm going to roll it into some other coin. Oh, wait a second. You got a tax on that 100,000. You might want to set that aside. I have clients that they want to invest to the very last minute. They don't want to give any money to the IRS. And so I said, well, hey, look, do yourself a favor. I know you want to wait because you're making money just, on these stable coins, just at least keep your tax money in a stable coin. Don't keep investing it because you never know if the market's going to go up and down. For example, 2017, markets went crazy, went way up, kind of peaked in December, January of 2018. And a lot of people said, great, I'm going to pay my taxes. it takes time to figure out your gains. By the time April rolled around, most people had lost over half their value in the decline on their values of cryptocurrencies. So if they kept their tax money in the form of crypto because they thought it would still make more money, all of a sudden it was really painful to pay taxes. And I know people who simply said, I'm not going to pay taxes because I'd have to sell everything I have. So because of that, they fell into tax evader status, which is not something they probably thought they were going to do 4 months earlier, that they would start to engage in behavior which is considered a felony. So this is just some general thinking on taxes.
Wow.
Hope I didn't scare anybody there.
You scared me. Wow. So, but I do pay my crypto tax. So, but I often get asked too, if you're just hodling or you're just buying and holding, then you don't have tax due until you sell the asset, right? Because
That's right.
that's gain or loss, and people get confused about that too. So, could you talk about that?
Again, it's property. So buying property, there's no tax on buying. There's no income experience when I buy property. It's when I sell it, I hopefully experience a positive income from that. And so that's when the taxable event occurs, where I experience some gain. So let's just put it in simple terms. Let's just say I bought $5,000 worth of XRP, and the price has gone up a year later, and I sell that for $8,000. Because I have some other reasons, I have experienced a $3,000 gain. If I held that, I said it was a year later I did that, but if it was like 365 days and less, that would be taxed. That 3,000 would be taxed at my marginal rate. Let's just say that's 24%, maybe 20. I'll call it 25% because I can do the math quicker. So we're looking more like at $1,250 in tax, whereas if I held it longer than a year, long-term capital gains rates, then I'm looking at a tax of only $450. Well, that's pretty interesting. So I might have done some math error there in my head doing on top, but you get the idea. This is really big. All right. Long-term capital gains is the way wealthy people make money. Now, if you're a frantic trader, like you hear about these people that are high frequency trading, all of that is at the highest tax rates that they would be subject to. So just because you hear about them, see about them, doesn't mean that's a smart way to go tax-wise. This is probably the most important thing about tax. You slave to gain money, to make your wealth grow. But we're then subject to tax. Generally, depending upon where you live and the situation, it's about a fourth to a third, maybe even a half of your income is going to go to paying tax. This is massive. All right. We think about growing the big number, but we don't think about addressing the tax number with simple things like where you live, how long you hold an asset, maybe rolling these assets into other tax protected investments. That is, the government, the taxes steal from us. And so this is very important to be thinking about along the way. We don't want to think about taxes because for most people, they get scared of taxes. Taxes make them uncomfortable and nervous because either they've done something wrong or they think they're going to do something wrong, or they think the IRS is around the corner listening to their worries. So all of this to say, we really need to have a proactive mindset about taxes.
I agree. Clinton, one of the things that, especially in the XRP community, that we're all hopeful for is that this lawsuit will end, Ripple will have an IPO, and that will propel the price of XRP much higher. So when you have a situation where someone has a huge gain in a cryptocurrency, what do you recommend? How much should they set aside for taxes? How do you recommend they handle a huge gain like that?
Well, that's a great example. Let's just talk about a 10x growth, right? Let's say you bought XRP at 50 cents and now it's $5. Okay. I mean, it could be, if you're a higher number, you can pick it, but 10x is big. All right. That's a massive amount of growth. That means you're looking at 90% of what you have is profit or gain. So in that example, $4.50 is gain. When you sell that, you're going to experience a tax. let's say it's a long-term capital gains tax. Is a long-term capital gains tax is 15% until your adjusted gross income is roughly a $500,000, and then it grows to 20%. On top of that, you hit a 3.8% net investment income tax. So, you're really looking at, that's on the amount over 200,000. The tax code's complicated, not because of the IRS, it's because of congressmen. They want to make it more complicated, and it just makes it befuddling to everyone. So what you want to do is when you sell, you want to set aside some of that money. Set aside like a fourth of it. Keep it in a stable coin, keep it in cash, because you're going to need to pay taxes at the end of the year. Technically, you should pay it on a quarterly basis as you experience the income. IRS wants you to pay that income quarterly as you go, but it's kind of complicated to calculate out. But let me just say that, we have no idea how we're going to end the year financially. Like here, I just sold it, made a lot of money, but my next two sales might be losers, so I might have to reduce that. But you want to set that money aside and keep it in cash, pay it to the government if you can, get it out of your hands, because the government wants their share. And you don't want to be somebody who plowed all that profit, all that gain into another coin that you had big hopes on, only to have it turned down. And then you're having to sell coins at a loss to pay your taxes. A very sad thing.
Yeah, definitely. Wow. I bet you hear all kinds of stories about things like that happening.
I had a client who, on the advice I said, he took my advice and he kept his money. He put $1 million aside. He put it in a stable coin, to pay his taxes. He was a high frequency trader. So he put it into Luna, and then Luna went under. He lost $1 million on Luna, still had to pay his taxes. Now, if he'd kept it in this old-fashioned thing called cash, then he wouldn't be hurting. And if he'd actually paid it as he had gone along on a quarterly basis, rather than holding out, because if you might recall, with Luna, you could then invest it with the Anchor protocol, that you could get like 19% return or some silly, fraudulent number, and that's what people were believing. And, if something seems too good to be true, don't do it. That's just, especially if it's simple compounding, and read, where's that money coming from? So other stories, I have had people who have made phenomenal amounts of money and they invested it, and then they continue to reinvest it, and then they can't pay their taxes at all. They've moved right into tax evasion mode. And so I have a number of customers that call us up that say, hey, look, I want to get current on my taxes. I'm afraid of the IRS. However, everything's down. I don't want to pay now. So, we work out strategies with them to, first of all, let's calculate all your gains for the last, I was at a conference. A woman came up in 2017. She made 300,000. All of this is on Coinbase. And she has never paid taxes, and she continues to trade. So I said, well, what we'll do is we'll calculate all your gains. All right. So know how much you would owe if you paid your taxes. And then we can start to pay it as you have the money to pay it, and we can, using our audit defense monitoring service, we can monitor your IRS accounts and see when the IRS has flagged one of your tax returns for an audit. We can generally see an audit flag 2 to 6 months before the audit. And when that happens, we can then real quickly file the tax return before the audit begins and avoid a 20% accuracy penalty and other issues that might come up, maybe even a fraud penalty if they found you haven't been filing for a while. For example, I had a client who uses our audit defense monitoring service, which is, it's basically, you can start as low as $12 a month, and we monitor your IRS accounts on a weekly basis. We actually pull the data from the IRS under a power of attorney, and we monitor what they're doing on your account. And it's really incredible. We give you a monthly status letter. Well, this guy, he had never filed tax returns, but he had our monitoring service. So, all of a sudden he had an audit flag. So we contacted him and say, hey, look, you're getting audited on 2018 and 2019. He hadn't filed returns for 6 years. We real quickly calculated all his returns. We filed them for all those years, and the audits never started. They closed them without starting. So it was, I don't recommend
Wow,
people
that is
operate that way, but
astonishing.
yeah,
Wow.
this is good stuff. We had another client who came to us, and my manager, my customer service manager, talked to him, and he had a debt. He owed a significant amount of money, and we put in an installment agreement in place. You can put an installment agreement in place up to about $250,000 without telling the IRS where your assets are. Right? That's privacy protected. While we were doing that work, because he had an installment plan because he owed debt for 2022. We looked at his records, and we saw that he was entitled to a refund. We call these hidden refunds that the IRS has no obligation to tell you about. And as a result, we were able to get him a refund of $100,000. And yeah, it's incredible. Of course, the IRS never, the money wouldn't go to him, because once they see that, they seize it to pay off his
That
installment.
was from crypto, though, Clinton?
Yeah, well, this was, I don't know what he was investing in, but there's a couple types of hidden investments. The two types of hidden refunds. The two types of hidden refunds are if the IRS mailed you a refund check, and because the IRS so backwards, if you get a refund, they mail you a check. All right, I mean, like who gets mail anymore, right? And who gets checks? So you say mail a check, and if it goes to the wrong address or it never gets cashed, it comes back to the IRS, and the IRS has no obligation to tell you about this. All right, so this is a hidden refund. Second type of hidden refund is good behavior type of refund, where if you experience penalties for failure to pay or failure to file your tax return on time, but like the 3 years before you had been like a perfect taxpayer and done it right, those penalties can be waived. And that's what happened for this one client. He had penalties of $100,000 for failure to file and failure to pay. And he basically paid his taxes like 6 months too late. He had a big bill, and he had massive penalties. But we got 100,000 back for him. I had another client who so this is a story nobody should do. All right. So this is not for any one of your listeners.
Okay.
He received Bitcoin from somebody who had been mining Bitcoin. So this Bitcoin had never been on an exchange. He had the Bitcoin. He, in 2016, sold Bitcoin and characterized it on his tax return as a charitable deduction, when in fact it had just gone into his pocket. The IRS picked up on this, and two officers from the criminal investigation group showed up at his house, told his wife they wanted him to come down. These are the guys with the guns on their belts. And they, he came down, he talked to them. They said, well, we're going to be watching you. All right. And about a year later, he gets a call from a U.S. district attorney informing him that he's being indicted for tax fraud because of what he had done. They had, and this is good because it's I think like XRP is also a UTXO based coin, right? So what they had done was they had dusted his wallet and with satoshis, just the smallest amount you can. I'm not sure if that term is in the XRP blockchain, but and then anytime he did a movement, they could see these satoshis move, and they said, we have proof that you had this wallet, you had gains you didn't report, and they indicted him. There's no proving how much it was. They just, as long as they can prove you did this and didn't report over $10,000, he was dead. So it was up to the plea bargain. Anyhow, long story short, he ended up having to pay $240,000 to the IRS in penalties. He spent a year in jail with 6 months probation. He had to go back, and this is when he contacted me, because he had to go back and file 6 years of tax returns real quickly, which we did. But in the process, because up until that year, he had been good behavior with his taxes. I got a $75,000 refund back from the IRS. All right, because we could watch and see his accounts and what we're doing. So there's a lot of money to be made back from the IRS. The IRS is watching you. Why shouldn't you watch the IRS?
Well, I'm astounded that you have a way to watch the IRS and find out if they're about to audit you. I mean, that to me is the most shocking thing that I've heard in tax for a long time. I love it though.
Yeah, there's nobody else doing it. I mean, the technology is out there. It's because of innovations with the IRS, with API access to this data. There's programs that use it. There's that can pull this data, but only we only know about one program that really is good systematizing it. And we've spent hundreds of thousands of dollars enhancing that work to be able to generate this type of reporting. There's nobody else out there in the entire tax industry that has gone mainstream with this type of offering. We have we do the monitoring at $12 a month, and then we also not only just monitor, but for crypto investors, we can give you protections like car insurance for your tax return. If the IRS selects one of your tax returns when you're a member for audit on the cryptocurrency reporting, we'll defend you at no additional charge for the entire life of the audit, all the way through the examination, appeals, and up into tax court. I have 3 cases in tax court. We're doing quite well with them. I actually have a 30% win rate with audits. The national average is 0.5%. Now,
Wow.
what is a win rate? Right? Well, win can be defined a couple different ways, but this is basically a refund rate. That means the IRS came after you, and when the audit was over, they paid you money.
Wow. Good for you,
So
Clinton.
yeah, I mean, I watched the IRS like a high school football coach watches the opposing team's games the week before. That's what I do. You know, I watch them, I study them, I know more about how the IRS defends things. I know I mean, when I was at the Consensus conference, which I went to right before we met, there were 6 IRS agents at the conference, and I met all 6 of them. We talked. I understood their game. They wanted to know what I was doing, because I see all their weaknesses. So anyhow, I got a lot of stories.
Well, how much in crypto should someone have? Okay, so let's I'm hearing there's 2 services you offer. So there's the less expensive service, which is just will tell us, it will watch the IRS and it will tell you if they're about to audit you. So that's your first lower level service. And then your upper level service is what you described as insurance against being defended, right, for an audit. So how much crypto does someone have to have at the higher level to make that worthwhile?
I think if you're around 200,000 in assets, I think it would be something worth considering, because we have 2 price points at the higher level, depending upon how much risk you want to assume. But even at the highest price point, which is $249, roughly $3,000 a year, that's 1.5 percentage point protection on your wealth on an annual basis. Rest assured, if the IRS audits you and you don't have this type of service and you have something you have to defend, you're going to be moving pretty swiftly to $100,000 in expense. Now, to be sure, if you're just a hodler, your likelihood of being audited is pretty low because you're experiencing very little gain. You're having very few taxable events. All right. So maybe a monitoring membership would be fine for you. If you're in addition to maybe hodling certain coins, you're also a high frequency trader in other coins, then you are going to become a much more visible target to the IRS, and it'd be very appropriate for you to do that. I mean, how can I describe this? So a typical audit, you're going to get a letter from the IRS, and they're going to say, hey, we want to look at your gains, and they're going to ask for all your bank records, all your credit card records, your loan records, every financial record you have. They're going to want all your transactional records from all the exchanges you're on, and they will analyze the numbers. They'll look at the gain. Now, when we do an audit defense, the first thing we do is recalculate the audit. We generally recalculate the gain numbers better than the taxpayer did, and this is the basis for the refunds typically. And then we defend it from that point. So we never have to defend your numbers. We defend our numbers. The IRS sometimes will acquiesce to those numbers if they don't want to fight it. Other times they have gone to bat against some of our clients. I have one client who had roughly 100,000 transactions in 2008, 17, 18, and 19, and they got really down dirty trying to audit it. He eventually caved and paid $3,000 for the first year, but then they caved on the second 2 years and had no charge. We felt that we could have fought the $3,000, but he basically got out of all that with just paying $3,000 to the IRS. I mean, when you're in audit, Linda, it's a very stressful thing because IRS cultivates fear and they terrorize you. And audits typically take two years or more, depending on how many stages of it you have to go through. And this could be very divisive on a marriage. Typically, one of the partners is the investor, and the other one is like, "I told you never to invest in those cryptos. You never listened to me, and now they're going to destroy us. They're going to take our household. The kids won't go to college, you know." And I mean, the fear and the terror every night when you go to bed, it's like the agony and because the IRS is just slow about everything, and it married people get divorced. It's terrible. It's terrible. So it's nice to have like an insurance policy, knowing that those expenses are capped. It's just not going to go up and up and up and up, which is what happens if you don't have this type of policy. Lawyers will bleed you dry. We have one client right now who we did the gain calculation. We said he should get $13,000 back. The IRS did the gain calculation. They said he owes $1.5 million. We took their gain calculation. I have in-house forensic accountants because we do tax returns all the time for crypto investors. We have our own in-house forensic accountants. We dissected the IRS numbers, came up with a 77-page document of all of the mistakes they made under section 7291 of the tax code. If we can show that the IRS has made substantive errors, the burden of proof shifts to them. That means the judge doesn't believe the IRS. So that's our attack point. And we've taken that case up to court. We've been working with appeals. Appeals has said, "Oh, we're going to recalculate the numbers." We said, "Oh, that's great. I hope you know that this guy had about 100,000 transactions." And it's, "Oh, well, we got an Excel spreadsheet program one of our guys wrote. He's going to calculate this." So really, that's really interesting. Because we just didn't believe that. I mean, Excel can't handle 100,000 lines. So. Then they came back to us about a month later. We asked them, "What's the status?" They came back to us and said, "Well, we're having problems. That program can't handle all the transactions, and we have another program and it can't handle all the exchanges this guy did. So we're just going to have to use your numbers that you came up with and verify those to see if we're going to, challenge this in court," which means they basically conceded because we destroyed the IRS numbers. So and I have another court case. Same thing, but this guy had 250,000 transactions and they want $2 million from him, and they just screw up left and right. So that's what we do. I actually have a lot of this show. I have fun doing this sort of stuff.
It sounds like you enjoy what you do, Clinton, and that's a good thing because somebody has to.
We want
to do it.
Taxes are actually quite fun if they're not your taxes.
That's for sure.
Anyhow, I got going on some stories there. Hey, I just have a passion for helping people. I have a whole company. We have about 25 employees, immense professionals from Deloitte, from BDO, people from Citibank running my company, and just a high level of commitment to quality and consistency. And people come to us who are massive investors, household names. If I mentioned them, you would know about them. They come to us to have their gain calculated because we actually do gain at calculation at a fixed price basis, small, medium, large. We do it what nobody else can do it. I have clients that said, "Oh, I was working with this one company and October rolled around," which taxes are due in October, and they said they wanted another $30,000 to finish the gain calculations. $30,000, good grief, they didn't know that earlier. So we fix price everything. We validate the pricing at the beginning, and we don't surprise people with additional charges. And that's why we have the most, I have about 50 or more clients down in Puerto Rico, which is where you go when you're very wealthy, the U.S. tax haven. There's a lot of strategies that ways that we help people with their tax preparation. But the biggest one is that we can defend you when the IRS is coming after you. And I think everybody should be defended. I mean, the IRS has gotten weaponized by Congress. 87,000 more agents will definitely come on board. They got $80 million of funding. And I just saw an RFP that came out last week where they're looking for new analytical software to go out and discover people who aren't reporting their crypto gains. And this is a kind of a scary thing. Last week, 2 congressmen wrote to the IRS commissioner and told him that he needs to crack down harder on cryptocurrency investors because we're losing too much money to their non-reporting. one level, that's kind of scary. If that was your congressman, I'd probably want to shoot the guy. But emotionally speaking, but it is true. Roughly 75% of all crypto investors aren't reporting. The IRS knows this, and the IRS is definitely focused on crypto compliance. So the biggest thing to know about is if you're having that, big payout day where XRP hits $50 or wherever your sellout point is, set your money aside, pay your taxes. They won't come after you if you pay your taxes. And this is the best way to protect yourself.
Is there a certain threshold that the IRS looks at for a gain to audit? So, like, are they, looking at $600 gains that are not being reported and they're flagging them for possible audit? Or is there a certain threshold that they're flagging for audit?
Well, the IRS can't tell what your gain is. They can see the proceeds, that is the value of what you sold, but they don't know what you bought it for. Um, and this is a good point. That's a really good question, Linda. Just following on to that, how does the IRS know what you sold it for? Well, if you bought it or sold, if you sold stuff on a U.S. exchange, most U.S. exchanges, the IRS has insight through a variety of different ways. They can see how much you've moved, whether it's a 1099 form that Uphold has sent to the IRS, or if they've used some sort of court summons to pull records from an exchange, they can see that movement. Now, if you're trading on a decentralized exchange or a non-US exchange, let's say you're trading on Caleb and Brown, Caleb and Brown doesn't have a reporting obligation to the IRS, so they're not going to tell the IRS that. So but in this year, in 2023, at the end of this year, you'll get a new tax form from all the exchanges in the U.S. It'll be a 1099-DA for digital assets, and all the exchanges are going to have to report your proceeds number. So what they do is, and this is the information we look at when we monitor your IRS accounts, we total up all these proceeds, including your salary and any other 1099s you got, for a total amount of income that should be appearing on your tax return. This is positive income, not adjusted gross income. And then we look at your tax return to see how much you reported. And if those numbers, if you're showing a lot less than what the IRS knows about, then you're going to be a target for an audit. That being said, it can be complicated because I have one client who's getting audited, and he really did maybe 50 trades on Coinbase, and they're all pretty small dollar amount, and we don't know why he's being audited. It's going to be a point of interrogation with the auditors. Why are you auditing this guy? He did nothing. I tend to suspect that he is linked to somebody else who did something bad. So I think that would be the basis of that. The IRS cannot see at this time your activity outside the U.S., but I think that's changing. We have, I mentioned the RFP. I've had a couple companies come to me with anti-money laundering software, which would basically, we type in someone's name like Linda P. Jones. Here's her Twitter handle. Here's her email address. And they go out and they search public domain information, and they start to gather, oh, this woman likes XRP and the Stellar thing, and like she's big on these coins. And then they can go in, they correlate it to your Coinbase or Kraken, the Uphold wallets, and they branch out from there, and they start to build this spider's nest of a web of all the places you're trading, and they can intelligently look at it and say, oh, these movements here are probably back and forth to a personal wallet. Here you're moving it to another exchange. We can see they don't know what the cost of these transactions are, but they can typically see the dollar value. And this is going to give the IRS significant insight, not necessarily accurate, but significant insight into the amount of money people are trading. So if you're somebody who's not reporting, you need to make a plan to get current.
Yeah. So if they're not seeing transactions that are done on foreign exchanges, is that true for Uphold since it's in the UK?
Uphold has a license in the US. They also have a US operation.
So they're reporting here, but it would be true for BitTrue since that's in Singapore. They probably don't see our BitTrue trades. Is that right?
Possibly that would be correct. So like Binance had Binance USA, so they didn't see Binance Internationals, but they did see Binance USA. BitTrue is non-US operating. There are other exchanges like Coinbase and Kraken have US and non-US entities. Not that people are concerned about the non-US. That's true. Now a lot of people say, now, a lot of exchanges don't want U.S. taxpayers because there is a law called the FATCA law, the uh, Foreign Account Tax Compliance Act, which obliges foreign banks, including financial institutions, to report to the IRS twice a year the maximum value of your account in dollars at those exchanges. So they don't want to comply with that, so they refuse to have U.S. clients. So like Binance International, they tried to do this. Companies like KuCoin, who, to my knowledge, are not doing KYC, are living on the edges of compliance legality. The fact that they don't deal in dollars means they're not too afraid of the U.S. government, but the U.S. has a way of cracking down on these things. This was true for Bybit, a very big exchange for high frequency traders. They've now caved and they're doing KYC because they are going to report back to the U.S. Twice a year on the account balance as a U.S. taxpayer. So the very fact that the FATCA law what the U.S. would know through the FATCA law is that you had an account at BitTrue, and they probably know the highest dollar value of the assets you had at BitTrue twice a year on that account. So they're not so in the dark.
Okay, well, that's interesting to know. Wow, this has been very enlightening. I'm so glad we talked and you could enlighten everyone about how this works and what's going on. And of course, we calculate our gains, and most of what we're doing is hodling. So it's not like we're not high frequency traders. This isn't any kind of a big gain situation that we've been dealing with. But in the future, I do think that we are going to see some big gains. So it is important for people to prepare and know ahead of time what their plan is and how to handle it. So thank you for sharing that with us today.
Everybody expects to sell, so everybody should plan on paying taxes. And taxes are not something to be afraid of, Linda. I mean, the richest people in the United States, live in, New York and California, and they're paying lots of taxes, and they continue to get wealthier. So we should not feel that taxes are depriving ourselves of our worth. We should focus on what we're keeping, which is generally 70% or more. So, and we can still become quite wealthy on that 70%. But if you ignore the IRS and don't pay them their taxes, the penalties, the interest, and the worry will catch up with you, and they will possibly destroy all the wealth that you do have. So definitely plan on it. Taxes are a very sexy thing to be thinking about, not something to be fearful of. And so I'm glad I could talk to you and your staff and all your listeners about the importance of paying taxes.
Well, and thank goodness, Clinton, we have people like you to rely on and to go to when we need help. So we appreciate all the work you do and the information you shared today. And thank you for being on the show.
You're welcome.